a lot of people get very confused about the concept of tax residency. So I'm going to try and explain it. It's actually pretty complicated, but I'm going to try and break it down to exactly how tax residency work and why is it important. So now perhaps, first of all, why do we even need to know where someone is a tax resident? And the answer is that most countries tax their tax residents for their global income. So if you are a tax resident in a certain country, that country wants to tax your income wherever it comes from. And then on top of that, sometimes there are certain benefits and countries give certain breaks. But the starting point is that if you're a tax resident in a certain country, that country wants to tax you for all of your income, regardless of where it's coming from. If you are not a tax resident in a country, sometimes that country will want to tax you, but only for the income that you generate in that country. So a tax residence, the idea of a tax residence is that it's a concept that allows countries to tax people for their global income. So sometimes people confuse tax residency as a good thing. They think, oh, how can I be a tax resident in a certain place? Or how can I retain my tax residency if I'm leaving? And they think that the tax resident somehow helps them. But normally, a tax resident is just something that comes to impose tax. Countries want to make people or to see people as tax residents, and people rarely want to be seen as such. And I'll come back to why this matters. Okay, so where are you a tax resident? And the general idea is that you're a tax resident in the country where your main home is, where you normally live. It's where you're based. And then some countries will take a very quantitative stance on this and say, oh, you're a tax resident if you're in the country 183 days or more in a year. Some countries will say you can be a tax resident if you're here for even a much shorter period of time. Some countries will say you're a tax resident if you have a home in a certain country. If you have a permanent home that's available to you and you can live in it, then that makes you a tax resident. So there are different criterias. And one thing that sometimes happens is that people can fall into the definition of a tax resident in more than one place. And this is where it gets kind of interesting and complicated. If someone splits their time between country A and country B, and they have a home and maybe work or other connections in country A and country B, then perhaps both of these countries will want to see them as tax residents. Now, what happens is that people tend to ask their local accountants what makes me a tax resident, and where the local accountants will normally look first is the internal legislation of the country, which defines tax residency, typically in a very broad fashion. So if someone is, for example, in the US, sometimes even a month and a little can deem someone a tax resident, even if they're not a citizen. In the UK, being 90 days or more in the UK can deem someone a tax resident. In Portugal, owning a main home can deem someone a tax resident, even if they don't spend a lot of time in that home. So sometimes people can fall into the definition of a tax resident in more than one country. And that is what we have something called double taxation, or the agreements for the prevention of double taxation. And these are agreements between two countries that set out rules. If someone is a tax resident in more than one country, how do we now decide where that person is a tax resident? And the outcome, if there isn't such an agreement, then the outcome is that the person can only be a tax resident in one country. So the agreement sets out rules. They're called tiebreaker rules that explain how you determine the tax residency of a person if they happen to be a tax resident in both countries based on the domestic legislation of these countries. So it's a two-stage process where first you need to look at the internal legislation of a certain country. So first you check, okay, based on the rules of this country, am I considered a tax resident, yes or no? And then if someone ends up being a tax resident in both countries, for example, someone owns a home in Portugal and spends 6 months a year in the UK, then both countries now would like to deem that person a tax resident and tax their overall income. But luckily, there is an agreement. So the next stage is there a double taxation agreement? Is there one between the UK and Portugal? There is. Great. Is there one between the US and Portugal? There is. Great. So now we look at what the agreement says and we go to the tiebreaker rules. And the tiebreaker rules give us a list of conditions or a list of rules that we look at. It's typically where does the person live, and if they only have one home, then it's they're a tax resident in the place where they have a home. If they have homes in both countries, then we move on to the next criteria, which is usually where is most of their commercial connections and life connections to a certain country, and then it keeps going down. But there could definitely be an outcome whereby someone ends up being a tax resident based on the domestic legislation in more than one country. But then we have the double taxation agreement, and that double taxation agreement gives us clear rules on how we determine a person's tax residency. Now, why is this important? Because the country that where a person is a tax resident is the country that gets to tax this person on their overall income. And then the double taxation agreement also tells us how the taxation rights are divided between the country of tax residency and between the other country. There are cases where people want to keep their tax residency. For example, if someone is a tax resident in a country that doesn't tax foreign income and all of the income of a person is from a foreign source, that tax residency makes it easier for a person to receive income without paying tax and without being queried about their tax residency in other places. So, for example, people in Portugal under NHR receiving only dividend and interest income, which is exempt from tax in Portugal, would want to keep that tax residency even if they stop living in Portugal. We have clients who are very worried what will happen if, for example, they will travel for a long time and won't stay in Portugal for a long time. And they shouldn't be, because countries don't normally give away, say, okay, you're no longer a tax resident now. We're no longer interested in taxing you. This is not how it works. It's actually exactly the opposite. Countries always want to deem someone a tax resident. So yes, in theory, if someone is not present in a country at all and they divest all of their connections and they no longer have anything to do with the country, in theory, the country can say, well, you've stopped being a tax resident, you no longer meet the criteria. In practice, countries want to keep you as a tax resident because you could come back and eventually pay tax. So the countries will very rarely voluntarily tell you that you've stopped being a tax resident. It's exactly the opposite. So if people leave a country for travel, for example, they don't normally lose tax residency. They only lose tax residency if they move to another country and gain tax residency in that country. And that normally disconnects the previous country. So equally, another issue, someone wants to disconnect tax residency from a country because they no longer want to pay tax in that country. So suppose a British person starts traveling. They don't lose their British tax residency unless they travel nearly all the time. But if they move to a country that gains tax residency and that country has a treaty with the UK, then they can lose their UK tax residency. It's a lot easier this way. What happens if people have a connection in two non-treaty countries? So they split their time between two countries that don't have a treaty with each other for the elimination of double taxation. In that case, the normal scenario is that they do need to pay taxes on their overall income in both countries, and that can obviously be very unpleasant. I think that's pretty much it on tax residency.